let's do the last component, or well, the third component we talked about, which was the cost of capital, the cost of equity concept, right? That is quite an important one for many reasons. The primary being that, okay, well, if I have a view about the company, about the stock, cash flows into the future, and I need to discount it back, what is the basic concept of a discount rate or a rate, right? Why we are saying, as an example, that okay, if something is worth 1.1 next year, typically what is its worth today? Should it be lower than 1.1 or higher than 1.1, or no difference? Lower, right? Yeah. Yes, lower, right? So which means that, let's say if today's worth of something is $1 and the appropriate opportunity cost of that $1, which is what we refer to as a discount rate, is 10%, right? So 10% is the opportunity cost, which means that if I don't end up putting it here, I can put it somewhere else and get the 10% rate or interest or return or all those things. Its worth next year will be 1.1, right? So 1.1 is the future value of this money, 1 is the present value of that money, the appropriate discount rate is the 10%, and so on and so forth, right? So which means that in our application of this PV FV concept, we are deriving the future cash flows, we are present valuing it back to today as a lump sum value based on this particular discount rate, but based on this particular opportunity cost as well, right? So it's an opportunity cost concept. Now, whether the opportunity cost is for the entire company, which is the WACC, or the opportunity cost should be only for the equity holders. So let's first understand the concept to the equity holders point, right? So let's say you are the investor. What are your choices of investing, right? What can you do? You can keep it in cash, you can put it in the bank, you can opt to invest in any of the risky investments, right? It could be a low risky investment, it could be a high risky investment, but they are all different degrees of risk, right? So let's say now we have two choices, if we kind of cut down into two choices, right? The first choice is to put it in a bank and in a fixed deposit, right? So what is the interest you might expect in a year, right? 1%, 2%, 3%, so on and so forth, right? Quite low return. Why is there quite a low return? Let's say it's 2%. Why is it 2? Why not 10? Why does the bank give you 10%? Besides them making money, but why? Because the primary concept in here is it's of relatively low risk, because you know that most of the times, or you have that comfort that this $1 that I invest with the bank should give me a 2% return over and above without taking any risk. I can sleep peacefully in the night and everything is fine. No, but I'm interested in not only earning 2%, I'm interested in making more money. But if I want to make more money out of this $1 that I have, what is it that I have to take? I have to take risk. If I don't take risk, I'm only getting 2. That's all it is. So now that I am willing to take risk, let's say I am able to take risk, the question is that how much risk I should be willing to take. Now that answer to that concept is very independent, right? It's very unique to everyone, right? You might want to take low risk, you might want to take higher risk, that's irrelevant, right? But different degrees of risk may be taken, which means that, let's say if you are an investor and if you're investing in, let's say, Apple stock, right? How much do you think you'll be taking risk by investing in Apple stock? First of all, will you be taking risk? Because the price of the stock in 1 year's time can go up or down, right? That is risk, that is uncertainty. right? Unlike you putting it in the bank and getting a fixed deposit, that is for sure, hopefully you should be okay getting a 2% return, right? But over here it's risk. So there's a basic principle, and it's not about valuation, it's about finance concept 101, which is the concept of risk and return, right, which typically goes hand in hand, and which typically there is a trade-off, right. So which means that if you are willing to take risk, you may be, because it's risky, you may be compensated with a higher expected return, right. It's expected, it may or may not happen because it's volatile, it's risky, but that is what you want, and you're willing to take risk, and which means to a certain extent, if I'm not taking any risk, I'm getting 2. If I'm taking more risk, I should be getting 5. If I'm taking a bit more risk, I should be getting 7 or 8 or to some extent. It's not directly correlated in terms of the more risk you take, the more return you should expect. But to some certain extent, if I am taking more risk, then I should be compensated accordingly. Basically, a basic point of risk return trade-off, right. So this is very, very important in the world of investments and finance. Okay. So moving beyond that point, the question is that can you tell me, if you invest in the Apple stock or in DP World stock or one of these stocks in general, should you be seeking a return as an investor? Because if you're not getting the adequate return in this stock, what would you do? You take the money out, you put it somewhere else, where it's adequately compensating you for the risk you take, right? As an investor, are you satisfied with getting a 2% return in investing in the stock, DP World? No, it's just too low, because it doesn't seem, right, that why should I be getting 2% if I'm anyways taking risk, right? So there is a concept of risk premium that in your mind you are building up to seek some sort of satisfactory return. So if I tell you that, okay, what if you're getting 10% return? Is it fair to you? May or may not be, but at least what's clear here is how much is the risk premium that's built in here. How much was the risk free that you were getting regardless? 2. So how much is the risk premium? The remaining, the 8. Clear? So now the return, the opportunity cost can be then broken down into the risk free portion and then a risk premium portion. And it's this risk premium that you need to calculate for DP World. And it may not be the same for Apple or for any other stock, because some stocks are relatively more riskier, some are more risky, some are less risky, and you would adjust your risk premium accordingly. So far so good? Now let's understand how do we build that risk premium in. So there is a in finance there's a concept called beta, right? Calculating beta, anyone knows what it is? What is beta? It's the measure of, well, it's actually a measure of risk, but specifically it's a measure of systematic risk. Okay, so what is systematic risk now? We can go on forever, right? So what is systematic risk? Yes. What is it?
It's the total risk.
Yes.
On all of the securities.
Okay. You're there, but maybe more, yes, and you would like to add?
Maybe from external factors.
Correct. Yes, no, so that's right. That's part of this mystery in general. So essentially, the point is right. So let's understand the concept of risk return better to understand beta better, right? So very, very simply, if you invest in one stock as an investor, you are taking the total risk of that company, right? You invest in Apple stock, what risk are you taking? You're taking the risk of the CEO's decisions, the products that they sell, the industry, the market, the trading, you're taking all the risks, right? But the basic principles of, again, portfolio management is if you end up buying a diversified pool of stocks or securities or investments, right, then some of the risks of one security may be offset by the other. And essentially, the primary risk that you as an investor would be exposed to would be largely correlated with the performance of your stock relative to the underlying stock market. Okay, too much going on? I'm just trying to find simpler ways to make you understand in a half an hour session more. So, essentially, if the, let's say if I was interested in investing in the Apple stock, let's say the underlying benchmark is the S&P 500 index. S&P 500 index is a measure of market performance, right? The US market performance, equity market performance. If the S&P, and probably the visuals might help, right? And you know, if the S&P is expected to behave, of course it's volatile, right? So it's expected to go up and down and up and down, and that's the behavior of S&P. Okay. Now the behavior of my stock, Apple stock, whatever I'm trying to value, its expected behavior is like this. Do you think, through my actions hopefully, does it seem to be more riskier than the performance of S&P 500? More riskier, right? Which means that beta is a measure of that risk for that stock relative to the risk of the stock market as a whole. Which means through my actions, if S&P's risk is, let's say, always the benchmark risk is, let's say, 1. It's a relative risk we are talking about, right? Is 1. Yeah, that's the market risk. S&P, this is, let's say, 1, right? Yeah. And our stock's risk is like this. So can I say that its risk is 2, right? 2 times riskier than the stock market, right? One is this volatile, one is, you know, almost double, right? So its behavior is pretty much, you know, magnified, right? Twice, right? 2 times in general. So which means that if I can kind of progress on this concept, what it means is that if I'm expecting a premium for the S&P 500 for 2020, or let's say for next year, to achieve a premium of 8%, which means a total return of 10, out of which 2% is risk free, remaining is the risk premium. So if I'm able to expect, just an expectation, if I'm expecting a premium in S&P 500 to be 8% and my stock is double risky as the S&P 500, how much premium should I expect for my stock? 2 times. Isn't 2 times, right? So if the S&P 500's premium is 8%, am I right? 8%? And my stock is twice as risky as the underlying market, how much premium should I expect? Twice. 8 times 2. Clear? On top of what? Risk free. And that is simply giving you a simplified version of how to calculate the cost of equity. Okay. So what are the components? There is a risk free component, there is a beta component, there is a risk premium component. All of that collectively will help us to get to cost of equity. Okay. So I just kind of made this during the break. So risk free 2%, yes. Beta in our case was 2 times. It's a unit is times, yeah, it's a multiple times, it's a relative measure. Again, what is the meaning of beta? Beta means that it's a measure of systematic risk. And what is systematic risk? Is the risk of the market. So if the market risk is 1, my stock's risk is 2 times of relative to the market. Okay. So, it is a relative concept. So, which means that if the stock market, or we use what did we use? We used S&P 500, didn't we? S&P 500 index. So, please make sure what the concept of an index is, but simply if the stock market index had a expected return of 10%, right, stock market return, what is the stock market the risk premium? Oops, 8%. And how much should be my equity risk premium for my stock? Okay, so it will be 8% of the risk premium that the stock market is generating, but because my stock is twice as risky as that of the index, it will be simply times 2 and giving me 16% premium. And overall, my cost of equity for my company as an investor should be what? Should be simply 16% of premium on top of the 2% risk free, giving me an 18% risk, cost of equity. This is the most simplified version in general. Okay. Do you know what this model is referred to as? CAPM model, right? So, capital asset pricing model. Okay. That's just simply the building blocks in general. Clear? Now, usually risk free as well. How do we measure that? How do you measure that? In real world, what's risk free? I just gave you 2%, right? But how do you measure it? Some kind of a treasury securities return, right? Some kind of treasury security return, right? Now, that is up to you. You know, the choices are US Treasury bills, US Treasury bonds, UAE Treasury bill rate, UAE Treasury bond rate as an example, or some modification to that concept. Okay. But that is the concept, right? The concept is it's a treasury security. And just so we are clear, what is treasury security? Just so we are clear, it's a government issued security which is considered risk free, right? It's a government issued security that is considered risk free, right? So, that's pretty much the basics here. Using this principle, right, you are able to estimate that, hey, for your company's return, right, if you're investing $1, you should expect 18, because if you're not expecting 18, you should pull out, you should go somewhere else, right? It's not worth for your money, right, and the risk you're taking in this company. Also, let's say the after tax cost of debt is 8%. I just made up a number, right? But it's after tax cost of debt, right? So, one is cost of debt, one is after tax cost of debt. And what is cost? How do you estimate the cost of debt? So, how do you estimate? Any ideas? How do you estimate the cost of debt? Yes. Okay, very good point. So, interest on the loan, right? So, let's say okay, it is to a certain extent right. What happens is that you also now need to have an understanding of fixed income securities and bonds and bond prices and bond valuation as well now, right? Because there is a concept of the interest rate that the company pays may be only one of the components that makes up the cost of debt in general, right? If it's a newly issued debt, most likely it may be the interest rate, great, yeah. But if you can just note down these terminologies, we're not going over it today, but there's a concept called YTM, yeah, yield to maturity. So, if you need to understand by looking at DP World's books, if DP World has issued some kind of bond, some kind of sukuk bond, debt security out there, and if they have, especially in the distant past, then what you need to estimate somehow is the yield to maturity of those bonds, and hence collectively, for the total debt of the company in general, right? It's the YTM, or the yield to maturity concept, which is then referred to as the cost of debt, just so you know, yeah, which you then have to also adjust for by taxes. That's another concept as well, yeah. So essentially, overall, you should look at the YTM of the bond. If it's very simple, straightforward, no bonds issued, simple debt and everything,